Hey, Shane. Just the normal link. I see you in there now. Yep. Okay, bye.
Hello.
Hello. Look at you in your fake office.
Yeah, I know. I'm not allowed to actually go. They shut everything down.
Oh man. So yeah, we don't have Zoom webinars, and this is like the third webinar we've done, and so I'm not quite advanced in it yet. So this is how we've been doing it. Hopefully it works for everyone. Oh, I see.
It will work.
Here comes Ken.
We'll figure it out. So I'll just try to share my screen to. I'm going to put it on the PowerPoint presentation and see what happens. From the beginning. There we go. Should that pull up?
Not yet.
There we go.
There it goes. Yep, perfect.
So you see, you see the presentation view, right?
Yep.
Okay, cool. Oh, do you want me to leave this up just as kind of the entry one here, or?
Yeah, once we've tested with Ken, and then, so is it going to be Mark presenting then?
Yeah, Sharad's going to introduce, for Blackrock, I think it's Mark. I don't know him. He's an investment analyst, but yeah, they're going to be the one presenting.
Okay, so we'll test their screens, and then once we've tested there, let's get yours back up there, and we can keep that there.
Perfect. Perfect. Yeah, I'm not a big deal, Sarah. I don't have a bio. Nobody ever introduces me. Like, here's Shane. Go ahead.
Well, we will keep it short and sweet.
Yeah. I don't think too much of myself. I know some people when I'm presenting them, their bios are like a mile long. I'm like, come on, man. What's up, Ken?
So, and I've got someone else in the waiting room with just a phone number. Is that one of, oh, and they're gone. Hi, Ken, how are you?
Hey, Shane, can you hear me now?
Can hear you, yeah.
Yeah.
Hey, goes down.
Are you going on camera or no, Ken?
No, I can if you, but it's through my firewall. It doesn't allow us to have camera. I've got everything set up here though.
Do you wanna go ahead and pull up your presentation to make sure that it works?
Yep. Can you see it?
There we go. Perfect. There we go.
Is that
Yep.
is that going through okay?
That's perfect.
Okay.
Here's Mark.
That's a good screen. That's a good background, Shane.
Oh, thank you.
Are you in the lunchroom?
No. This is I don't know. It's our default.
Nice little lobby room there. Hi, Mark. Mark's. Sorry, when you guys come in, I have it set to just turn all of your microphones and cameras off.
How you doing?
Good. Thanks for joining us. I was telling Shane, this is our third webinar we're working, but this is different than what you guys have been doing.
Say that again, Taro?
Do you want to test your sharing screen, Mark?
I don't know if anyone else is getting feedback, but we'll probably all want to be on mute unless it's the person who's speaking.
Oh, here we go. I muted Ken. There we go.
Yeah. So Mark pulled his up, Ken has his, so we're good, right?
Yep.
Okay. That came over, Tara?
Yep, that's perfect. So we'll stay here as we start.
Yeah.
And then I will, go ahead.
You're seeing, and I just want to confirm because we have these two screens that pulls up presentation. You're seeing the whole screen, not the presentation side, right?
Right.
Okay. Perfect.
Just the slide.
Sarah, did you say you were getting some feedback from me?
I think a little bit, yes.
Do you want me to call in and just mute my, I normally have better success when I call in.
If you like, this does work if no one else is talking. But yeah, maybe because now I can hear myself.
Hey, Ken, if you click the top and then there's a phone button, it says mute, there's a little arrow next to it.
Yep.
You can actually call in right there and then it will disconnect your audio so you're not going to have the interference between the two.
Hey Shane, Sharad here, just testing the audio for me.
Now try that again with Ken muted now. Let's see what happens.
Who's muted? Oh, can you hear me now?
That's better, yeah.
That's good. Yeah, Ken's audio is having a little bit of an issue here.
No worries.
You look great today, Sharad.
I would put a shirt on. I don't know how to put a shirt on. It's been such a long time. I'm like, how do buttons work, you know?
Hey Shane, where did you say to call in? So
How about we have a minute here. Why don't you just disconnect and re-engage, but then don't click audio, call in on that number. So just disconnect and come back real quick.
Yeah.
If he calls in that way, will he be able to share his screen?
No, when you're connecting, it gives you the option to call in or use your computer audio. He went computer audio, so that's causing the issue. But if he reconnects, he'll be able to share his screen.
Gotcha.
But go through the phone.
Gotcha. Learning something new every day here.
So Shane, I'm guessing we're going to be Blackrock. Mark and I are going to be going in the last say 15, 20 minutes of it. Is that what you would?
Yeah.
Want? Cool.
You can fill up the time with whatever you think is relevant. I mean, I don't know how long or short. Tara, I don't know. Have you done questions throughout, or do you wait till the end? How have you done that in the past?
We haven't had many questions. We've had them put them in the chat window, and we get to them at the end, but there's maybe been one or none. So what I was going to say here was feel free to post them along the way in the chat window. And if we have time at the end, we'll get to them. Otherwise, we'll follow up with you at the end. The speakers will follow up with you. Is that all right?
Yeah, that's perfect. That's perfect. Yeah, my session, I'm just talking about some consolidation, cybersecurity, some trends that we're seeing. I mean, I might be 15 minutes or so, then Ken will go through his. So you should have plenty of time to do whatever you want to cover.
That's great. And just to get just to confirm, you know, we're the community we're speaking in today is basically the plan sponsor community, correct?
Yeah, so our clients are going to be accountants. They're going to be, we do a lot of employee benefit plan audits. So that's typically the client that we're seeing today. In our last couple of minutes, let me take a look real quick at who we've got here.
Yeah, no, I'm pretty sure we're in the same line. Yeah, I just wanted to double confirm and make sure, just because if there's any tweaks, you know, Mark is one of our speakers at Blackrock, and he speaks to a variety different groups of audiences. So he is so good that he can just cater things a little bit here and there. So I wanted to make sure that Mark had everything he needed. That's all. We should be good though.
We've got a couple people from Raymond James. We've got some controllers, CFOs, bookkeepers, a couple banks. And so that's generally our audience today.
Awesome. I appreciate that. And Shane, what I'll do is I'll give a very quick high-level blurb of Blackrock, and I'll introduce Mark and have him do his thing.
Yeah.
Cool. Thanks.
And Sharad, your last name, is that Gaston? Am I saying that right?
Yeah. So Sharad Vasanth, like Vasanth. Yeah.
Okay. Sharad Vasanth. Gotcha.
Perfect. And honestly, I've had my name butchered my entire life, so I don't take any personal offense to it whatsoever. You know, it comes with the territory of being unique.
Tara, when I'm wrapping up too, you want me to introduce Ken and then introduce Sharad, or are you going to introduce Sharad?
Yeah, so in the very beginning, I am just going to welcome everybody, let them know who we have speaking today, but no backgrounds yet. And then just a little bit of housekeeping. With that the SHRM, do you say SHRM or do you say SHRM designation?
SHRM.
You say SHRM.
SHRM.
Okay. I'll just go over the event ID. If they have questions, put them in the chat window, and then I'll introduce Shane with his super extensive bio, and then we'll move on to having him speak. And then when he's done speaking, he can
I know, with that bio, I may be the most important person this WebEx has ever had.
We definitely will have time for questions with that intro. So then if you don't mind introducing
I'll introduce Ken and Sharad. Did Ken make it back? What's up with Ken?
Is he?
Goodness.
Or is he? Oh, shoot. Oh, sorry, I forget we have a waiting room. Oh no. Oh, oops, I accidentally let someone else in. Hold on, he's been waiting.
Is Ken in there?
Yeah.
There we go.
That's all right if we start a minute late.
Ken, you good? You're on mute. Ken.
He was in the waiting room with two different names, so I've just got both of them joined just in case. The other one is joining now.
Oh my gosh.
See a phone number joining. I'm going to assume this is him.
Ken, he just got off mute.
Are you there?
Hey, can you guys hear me?
Yeah.
Yeah.
You want to share your screen real quick and then we'll get this thing rolling?
I'm on the phone as well. So do you want me to be on the computer or on the phone? Because it wouldn't let me in either way.
I don't get any feedback right now. Oh, there it is. All right. Okay, I'm muting you, Ken, but I just let the phone number and the 303 number. I assume that is you.
Ken, I'm gonna have to guide your slides, I guess. I don't know. Where's your deck at?
Ken, is this working on the phone for you?
There we go. We got Ken's presentation up.
Okay.
So be good. Ken, that's you sharing?
Is that phone number you?
Ken, you're on mute again. All right, let's do an audible.
Can you hear me, Shane?
Can you hear you?
Yeah.
There you go. So you're on the phone now, or connected through the phone?
Correct.
Okay, perfect.
Correct.
All right, we're good to go?
You can see my screen,
Yep.
Sarah?
Yep.
Okay,
All right,
perfect. Let's go.
I'm gonna let
So
everybody.
Shane,
Go ahead.
are we going with my screen, Shane, or not?
Yeah, if you could share it, yeah, but put your phone on mute just while you're not talking because you got feedback. So we're good. You could share.
I think we're good now that he's on the phone. All right, I'm gonna let everyone in.
Yeah.
All right, welcome everyone. Thanks for joining us today. We're starting off part 3 of our Employee Benefit Plan Summer Webinar Series. So today we're going to focus on the investment side of retirement plans. We've got some great speakers lined up. So with us today we have Shane Hanson from Empower Retirement, Ken Jackson with Pentegra, and Sharad Vasanth and Mark Peterson with Blackrock. So just a little bit of housekeeping for anyone with the SHRM designation. The event ID is 21-7CHRR. I'll put that in the chat window too for you. If you have any questions along the way, feel free to post those in the chat window. And if we have time at the end, we'll get to those. Otherwise, our speakers will be happy to follow up with you after the presentation. So to start us off, I'd like to introduce Shane Hanson. Shane is the Regional Director for Empower Retirement here in Boise, Idaho. He specializes in 401k, 403b, and non-qualified deferred compensation plans. So we've had the pleasure of collaborating with Shane over the last couple of years, and we're excited to have him join us today. So Shane, take it away.
Thank you very much, Tara, and your group for setting this up. Appreciate the opportunity. And the fun fact is I'm the only one in the state of Idaho that does what I do. So it's a really fun differentiator for me and really enjoy that. So today I have some partners that will be working on presenting and giving you an update with a lot of things around retirement plans. There's been a lot of change, both from a consolidation standpoint. Record keepers are selling off left and right. And there's some trends that we also wanted to update you, as well as a market update with Blackrock. So excited to share that. And again, if feel free to add a question in the chat feature, and we'll try to address all those questions as we go through this. So the first thing from a record keeping side, so those that you who have a retirement plan, you typically have a record keeper that is where you're going to go to access the website, to access your investments, to move money around, submit your contributions, etc. The world is rapidly changing in this environment. The record keepers, 99% of them are built on a mainframe system. So this is a busy slide. No need to look at all the little details. The gist of this is, a record keeper is typically built on a mainframe system, which was built off of an old banking chassis in the 1980s and kind of retrofitted for record keeping. It was expensive to update. It's not as fast. It batches on a nightly basis. And that's expensive for a record keeper to run. Record keeping is really around efficiencies. The more efficient you become, the more profitable you become, the more aggressive you can price your plans. And so what the evolution, and Power is one of the leaders here, but one of the evolution is converting to a modern server cloud-based system. The gist here is that this is a diagram of what a cloud server-based system looks like. It's faster, it is real-time data, and it's more efficient to operate. So you're starting to see this trend of consolidation. And what it is it's really going for scale. The consolidation, you're starting to see businesses that are not mainly focused on record keeping plans. It's a subset. So oftentimes they have an insurance division. They have different lines of business that are their priorities. Record keeping, unless you're really committed to it and have the efficiency and scale today, is going to be hard to continue for the long run. So as you can see on this slide, there are a lot of mergers and acquisitions happening over the past 12 to 24 months. And we only think that that's going to continue for the years to come until it really gets to a consolidated group that is hyper-focused on record keeping. An ancillary trend is, instead of selling the business, we're starting to see record keepers outsourcing overseas. There's a firm called Emphasis in India that is really taking an interest in record keeping in America. And so a lot of these record keepers, most recently Vanguard, has elected, instead of selling, they've elected to outsource overseas to lower that cost of operation. We see that as an interesting play from a scale perspective, and only time will tell what that is. That's a very different approach than having everything based in the United States and focus on our record keeping. 401k is really only here. So you want to specialize with people who know that marketplace, and outsourcing that is going to be an interesting play for years to come. So that's a secondary trend that we're seeing. The other thing is that there's been a lot of mergers and acquisitions dating back 10, 15, 20 years ago that we've been looking at. The idea around an acquisition is that you're going to acquire a record keeper to gain more participants on your system and scale that. But what we're starting to see a trend of is that doesn't always impact long-term success and growth. So many of these transactions on this screen are showing you historical acquisitions and what that is in 2020. So there's actually a pretty common trend that they've either stayed stagnant or actually lost participants. So just because someone is buying someone, that doesn't necessarily mean that's going to be long-term success and growth. And you have to specialize in that space. So to kind of wrap up the consolidation theme here and what's happening and driving this, as you're probably evaluating in your business, when you're looking at record keeping and you're benchmarking, something to consider is also, where does my record keeper rank in terms, am I at risk for a potential acquisition? Or am I on the acquiring side with someone who continues to acquire and invest in the business? And what is ultimately leading to shift in 2020, 43% of the marketplace of 401k plans were in the top 5 record keepers. Today, that's 54%. And with the recent acquisitions, we're going to see it higher than 60% in 2021. And that's just going to continue to grow. And a number for you to keep in mind when you're benchmarking or looking at data is industry experts are suggesting you have to have 5 million participants on your system in order for you to be at scale. And so maybe look where that ranks and have that as a thought process when you're going through the benchmarking is my record keeper at scale, and who is at scale? And the cost, the last thing from a consolidation standpoint is what to consider here is it's very expensive. We've had the CARES Act, the Secures Act. There's numerous updates that are happening from a regulatory standpoint that are expensive for record keepers. So some record keepers have multiple systems. That means that every time they do an update, they're having to update 2 or 3 systems, which is highly inefficient. There's obviously a cybersecurity risk. I mean, you just saw, I think it was T-Mobile, 100 million people just the other day. I'm getting hit left and right with emails on that. Cybersecurity and our data is a top priority, and that's expensive to run. And then just looking at the record keeper, is it a distinct business or is it a subsidized economics? What is the focus from my record keeping standpoint? And what is that going to mean for the long term? So I mentioned cybersecurity. I just want to give you a couple of data points on this and why this is so important. I personally think that this is one of the single biggest threats to the confidence of the American retirement savings community. The average bank account today is $5,000. The average 401k is approaching $100,000. And we've always tried to help participants, letting them know that you're not going to be day trading this account. And so they often don't look at it on a frequent basis. And what hackers and bad actors are starting to realize is that, there's a lot of static accounts that haven't been set up, that don't have dual authentication, all these different data points. And they're trying to breach the system. Record keepers like Empower and others are investing heavily to try to protect and secure those assets. So a couple things to just look at when you're going through the process. SOC 1 and SOC 2 are the highest level of American standards for the retirement community. And so maybe ask them, and then ask the record keeper you're with, do you have your SOC 1 and SOC 2? And then even deeper than that, ask them if it's specifically around their retirement record keeping system. Because often someone might have their SOC 1 and SOC 2 audit, but it's on their entire business line. Well, if they have 5 business lines, how deep does that go from a record keeping perspective? Ask them if they have a third-party validation system that has access to their systems to make sure it's secure. And the last thing is the Spark Institute. That is all record keepers coming together to share best practices. Because again, the last thing that I want my competitors or peers to face is a security breach, because that means that comes at the detriment of a participant. And so we're all banding together to try to improve. The chairman of the Spark Institute is actually Doug Peterson, who's the head of our cybersecurity and has a military background. So we're trying to lead the way, share these ideas with our competitors, and ultimately try to secure participants' accounts. A couple things to look at and kind of what's happening. Voice identification, when people try to call into the call center, is a big one that we're starting to see. We can check different tones of voice and see if that's a bad actor coming in to try to distribute those funds. ACH account verification, that's a very common one. If somebody hasn't set up their account, a bad actor goes in and tries to breach that account. The first thing they do is try to change that ACH and get approval of that so they can distribute those assets. So you just want to make sure, again, I can send Tara a follow-up. We have a 16-page guide. The Department of Labor just came out with their tips around cybersecurity. And we have a bunch of tips of what to ask, what to look for to make sure everyone is safe and secure from a record-keeping data perspective. So I can share that as a follow-up. And then the very last thing here, what does your record keeper do? How do they stand behind your participant? So there's 2 questions to ask there. Do you have a security guarantee? Meaning, do you stand behind our participant assets if something were to happen to them? So if somebody breaches the account and it's through no fault of their own, do you secure those assets, and will you make that participant whole, is the first one. The second one is, do you require an online account to qualify? Well, where a lot of people will say, yes, we offer a security guarantee and we'll make your participants whole. There's a bunch of check boxes that have to happen, including setting up an online account. And so you're going to want to look and check in on that in terms of an asterisk of their program. And then the very last thing here from a record keeping perspective is what from your standpoint is, you have a participant experience, cybersecurity, the website, all of that. And what is happening from your administration side? And what we're seeing is a massive trend towards investing to simplify your life as a plan sponsor. And so you'll see a bunch of services on the left-hand side. eligibility tracking, notifying participants of their eligibility, auto enrollment and auto escalation, again, automating that. But most recently, quadros and hardships and safe harbor, rather than you spending time to review and look at that, offloading that to a record keeping partner that's invested and has that included in their service is something that is really resonating with the marketplace. And then on the right-hand side, you'll see a number of notices that have to go out. Historically, a record keeper, the TPA, has provided that to the plan sponsor to distribute, but we're starting to see, again, a trend of investment into automation of required notices so that it really simplifies your life as a plan sponsor so you could focus on your business and not the minutia of a 401k. And so those are a couple of trends that we're seeing. I see there's a couple chat features. I don't know if there's any questions, Tara, if you want to ask me there, or we can transition here to the next speaker.
No questions so far.
Okay, perfect. So Ken, if you wouldn't mind pulling up your presentation and preparing to go to the next topic. So Ken Jackson is with Pentegra. So they're a third-party administrator partner that we have at Empower, and they specialize in TPA work, and they got a great update on MEPs and PEPs and the Secure Act. So Ken, go ahead and take it away, sir.
Good morning, everyone. Appreciate you all taking some time out of your day to join us today, and thanks to my co-speakers and Tara, much appreciated. So I've been asked to talk a little bit about PEPs, MEPs, ARPs, and GOPs. As you can imagine, they're an interesting group when you can bring all these acronyms into play. And then I'm going to briefly talk about Secure, and to follow on a little bit with Shane's talk about cybersecurity, I'm going to show you a little bit on cybersecurity as well. So in regards to the PEP, which was similar to a multiple employer plan, but the government came out with a new structure called a PEP, the pooled employer plan. And so far we're seeing it being a lot slower than anticipated. In December of last year, the Department of Labor anticipated there'd be around 3,200 PEPs and PPPs in place. To date, there's around 100. Partly this is due to the fact that they still haven't finalized all of the latest regulation. They've still got to finalize all the pieces to the pie. And so obviously that would slow down a little bit. And from our perspective, Pentegra's been working with multiple employer plans prior to ERISA, and we've been around since 1943. We're not actually that shocked that it's been a little slow. To be a fiduciary on a retirement plan is a little different to being a third-party administrator. The word third party is very key. So they provide the clerical support on the plan, but they're not a fiduciary. And so when you change your company or get into a situation where you become a fiduciary, it creates some different service issues. It creates some different ideology and understanding of how the documents are all meant to be followed. So one thing that I would caution on, the pooled plan provider or the PPP, you need to have an experienced fiduciary to fill that role. And that's one of the due diligence you should ask if you're looking at joining a PEP, is what is the experience of the pool plan provider? Because they're the main fiduciary on the plan. They have a lot of responsibility, and they need to make sure the boxes are checked. In regard to PEPs, we see really three things that matter. Obviously, scale matters. For them to be able to come back and the providers to offer a reduced fee, they have to have a lot of scale. If they can't get the scale, then the challenge is how do you spread the cost, or how is it absorbed by the plan, the adopting employers into the PEP. So be aware of that, looking to make sure that the plan has success. And what we're thinking scale means is PEPs need more than 50 million in plan assets before they'll hit that scale. So a lot of times we've had a lot of questions from the smaller advisory shops that are saying they want to set up a PEP. And the challenge they have is they can't get it to that scale. They can't get it to the 50 million where they're able to get the lower prices that they may have sold you on. And the last one is experience matters. Any prospective PEP client, you need to do a fiduciary, you have a fiduciary responsibility to make certain that there is an experienced PPP in there. You have to do what's in the best interest of the plan participants. And so therefore your due diligence with the help of Tara, the help of Shane, and your advisor, you can get a good understanding of what it is. To Shane's point earlier, SOC 1, SOC 2 are very important. On the TPA side, there's also accreditations that you want to look for. The PPP, while we say make sure they're not new, because PEPs are just recently come into play, we do want them to be, we do recommend that they've been serving in a fiduciary capacity, maybe as a TPA 316, where they're named in the document and they're taking on the fiduciary aspects for a period of time. There are a lot of people now who know the law, but very few have any real experience serving in a fiduciary capacity. So when you're outsourcing that fiduciary role, you still have the responsibility that you're outsourcing it to someone who knows what they're doing. So that's something that we would caution you on. There's a lot of marketing out there, but where the rubber meets the road is their experience in the fiduciary capacity. What's coming up next? Starting 1/1 of 2022 is a GOP, or what is called a group of plans. So they're coming 1/1 of 22. With a GOP, it's similar to what we used to have in the closed MEP, where there used to have to be a nexus or commonality. They've taken that out. So there is no nexus or commonality requirement for a group of plans. It's not considered a single plan by the IRS, but rather an aggregated plan that can file one annual retirement report or a 5500. So with a GOP, in the past, you used to have a nexus or commonality. By that, we would say, so Pentegra has a $4.5 billion closed multiple employer plan for financial institutions. So you have to be a financial institutions to be an adopting employer into that and to get the benefits of that. That is now gone. So a GOP can have a group of plans that now have one 5500, so you're all aggregated under that one 5500. There's also a benefit to the audits. So there is a shared service among employers, or audit relief is not to the level that it used to be with the closed multiple employer plan, but there is some efficiency that you gain through there. So they utilize the way to offer a benefit of larger plans by delivering scale to small employees. So you tend to get a lower cost, high quality services and fiduciary oversight. Again, this is a plan that's coming into play in 2022. However, just like they're having struggles with the PEP, nothing has been finalized, or not a lot has been finalized on the GOPs. They're still trying to finalize all the requirements for the PEP. I was asked to talk about Secure 2.0. The first thing that I'd like to let you know is that it's not in law yet. And what we're hearing from Washington is that this probably will not get passed until 2022. And rather than break down in the short period of time I have with you all of Secure 2.0, what I'd like to show you is that there are many sections that pertain to retirement plans. If you look at this, these are all the different areas in 2.0. And what I have for you today is I can show you, if you'd like, something like this, which will break down each of the sections into more understanding. Please reach out to Tara and ask her to forward on your email address so that I can do that. And then I will send you out that document that will break down all of the different parts to 2.0. But again, remember that 2.0 has not been approved yet. We're expecting it to be approved. The latest we hear is in 2022. As Shane mentioned, cybersecurity is a real challenge at the moment and a real concern. Now remember that you're all fiduciaries, and as a fiduciary, the Department of Labor expects you to do what's in the best interest of your plan participants. So I put together some points here that the Department of Labor have put out regarding what they expect a fiduciary on a retirement plan to ask in regard to cybersecurity. So they want to make sure that you have a formal, well-documented cybersecurity program. This is a provider. That they conduct prudent annual risk assessments, have a reliable annual third-party audit of the security controls, clearly define and assign information security roles and responsibilities, have strong access control procedures, ensure that any assets or data stored in the cloud or managed by a third-party service provider are subject to the appropriate security reviews and independent security assessments. Conduct periodic cybersecurity awareness training. I'm sure Shane would agree, and anyone that works in this industry, that our internal technology group are always sending out different security awareness. They're sending out trick questions, trick emails with different links, phishing attempts, and all that type of stuff to try and catch us, make us aware, and make the transfer of any personal information be very hard to come by. Implement and manage a secure system development lifecycle. Have an effective business resiliency program addressing business continuity, disaster recovery, and incident responses. I can tell you that a lot of my competitors in the TPA world, they're struggling with this because they never had the assets to put together a lot of these types of programs in the background. So if ever they got affected, they didn't really have this go-to resiliency program. Obviously, encrypting is huge, and the way that we encrypt the sensitive data, how we store it, and how it's in transit. Implement strong technical controls in accordance with the best security practices. And then, if you do have a cybersecurity incident, like T-Mobile, you have to appropriately respond to any of the past incidents and be prepared for when there is a new incident to act on it immediately. Any questions out there that I can help with? In closing, I'd just say that you need to have access to ask these questions of the providers that you're partnering with cybersecurity. You need to have these responses available. So if ever the Department of Labor comes in and does an audit or is looking at your fiduciary responsibility, that you can show them that you've had questions like this asked in an RFI or some type of interview process with your providers. Thank you, everyone. I'll hand off to the next one and stop sharing my screen.
Thank you very much, Ken. Mark, if you want to pull up your presentation, sir. I'll have Sharad with Blackrock introduce our next speaker. Go ahead, Sharad.
Awesome. Can everyone hear me okay?
Yes.
Awesome. Great. So thank you so much for your time today. A little bit about me. My name is Sharad Vasanth. I'm actually based out of Seattle, Washington. And what I do here at Blackrock is I work with our plan sponsor community, our 401k plans, as well as our record-keeping partners like Shane and Empower, and our financial advisors or retirement consultants, as we call it, in the Pac Northwest Territory. So I have Washington, Oregon, Montana, Idaho, and Northern California. Now, as a quick introduction to Blackrock, for folks who may not know who we are the largest investment management firm in the world. We manage about $10 trillion globally, ranging from index funds to active equity funds, active fixed income funds, as well as alternative investments. Now, 10 trillion is a very large number. And I'll tell you, I've been here for 5 years and I still can't grasp that number in my head. But what brings it down a little bit easier and a little bit digestible is that if we just focus on 401k plans or defined contribution plans on the whole, we manage about $1 trillion. Now, what's really great about that is 1 in every $10 that comes into Blackrock goes into the retirement space. And we're really proud of that number for the main reason is that the entire focus when we started Blackrock and when the co-founders started Blackrock in 1988 was the focus on retirement dignity and retirement security. And with that, having that focus on that over and over again, what we've also done is not only created all these different investment solutions that people can use for pension plans and 401k plans and retail clients, but we've also put a lot of thought leadership and a lot of education that's out there. And that's a perfect segue for me to introduce you to Mark Peterson, who is the Director of Investment Strategy and Education here at Blackrock. I joke around internally here and call Mark the unofficial spokesperson for our relationship management team here. And a lot of it is just because he does a phenomenal job in taking all this market data that's out there in the market and taking it and making it digestible for our clients. Today, Mark has prepared a presentation called Student of the Markets, which goes over some of the high-level trends that we're seeing in the markets. And if you have any questions, feel free to follow up with Shane. And I look forward to getting to know you guys individually more and seeing how Blackrock can continue to educate you more about the defined contribution space as well as what's going on in the market. Mark, go ahead.
Thanks, Sharad. Good afternoon, everybody. Thanks for having me on your call today. Talk a little bit about the markets. Obviously, not a shortage of content here. And we'll talk about it through our Student of the Market presentation. This is actually something that's end client approved. You can actually find it if you Google Blackrock Student of the Market. You can see, you'll get to our webpage that has not only the current edition, but also some past editions as well. So let's jump right in. As I mentioned, obviously a lot that's gone on here over the last 18 months, especially given the pandemic, the shutdown, the market correction and recovery. So I think it's good to just start with where the market's been, right? You look at 2019, probably hard to remember 2019, right? Anything before 2020 is tough to recall. But you can see how good of a year it was for stocks and bonds, right? 31.5% for US stocks, 8.7% for bonds. Followed that up in 2020. Granted, it was a wild ride to get there, but it was 18.4 for stocks and 7.5 for bonds. Great back-to-back calendar years for both stocks and bonds. And we actually went back in history and just look back, and we do this quite a bit in Student of the Market, how often you get back-to-back calendar years that are so good for both stocks and bonds, right? Not unusual for one of these asset classes to have good years back-to-back, but for both asset classes to have such good back-to-back calendar years is actually extremely rare. It's only happened 4 other times since 1926, so about a 95-year period. It's only happened 4 other times, most recently in the late 90s, twice in the mid 80s, once in the mid 70s. Prior to the mid 70s, it hadn't happened at all. So very rare that you have such a good performance, back-to-back, well above average return environment for both stocks and bonds. Of course, that's a good news, bad news story, right? The good news is that we've had some good returns, right, for portfolios. The bad news is history tells us there's never a third year, right? And we've seen that happen this year, right? That we knew something had to give. We knew most likely it was going to be on the bond side, right? It's just not realistic to continue to get 8 and 7% returns out of bonds when base interest rates are at 1.5%. So that bond number slightly negative year to date. That stock number continues to grind higher. We're actually closer to 20% today. This is through the end of June. But another good year, at least good start to the year for stocks. So clearly that's been the backdrop for us. Again, a little bit of good news, bad news. Very nice returns, but certainly something to had to give here in 2021, and that's been on the bond side. Take a little deeper dive on the bond story. If you just look back historically, this is the actual 5th worst start ever for bonds. Again, over that 95-year window. So long period of time. And this is the 5th worst start for bonds. I think one thing that's telling there is bonds actually, that's pretty good when you think about it, right? That 1.6% negative return for bonds. And that's the 5th worst. That's not too shabby. And you can see some of the other top 10 worst starts for bonds historically. We just went back and looked at what did those worst starts, what did those other 10 years look like the next 6 months? And you can see that they were all positive. actually the next 6 months of the year. So bonds tend to find their feet a little bit. Granted, some of these periods, interest rates were much higher, right? I think just about all these periods, interest rates were higher. So you can get a positive return just by clipping the income right off that bond portfolio the next 6 months of the year. And clearly that happened in some of these periods, right? Like 96 and 84, for example. But even look at 94. 94 actually ended up being the worst year ever for bonds. And you can see most of that loss was in the first half of the year, right? Down 3.9%, up 1% the last 6 months of the year. So certainly something to consider, right? Bonds have struggled, but they have found their footing here a little bit and have reduced some of those losses here versus the very first start of the year. On the stock side, I think one of the stories is just how powerful the rally has been since last March. This is a chart that we actually updated. We used this last year to show some of the worst days in stock market history and worst months and worst 3-month periods. And you can see we had 3 of the worst 15 months, or excuse me, 3 of the worst 15 days since 1950 last year. 3 of the worst 15, right? And you can see what stocks did 1 year later, right? Up 69% following March 16th, up 61.8% post March 12th, well above average for all these periods. You can see the average is tremendous, right? 30% following these worst 15 days in stock market history. But our rally's been well beyond that. And I think that's something to note, right? This rally has been significant since those lows in March. And you can do the same thing for worst months as well, right? Similar story. Really illustrates how powerful the rally has been. Worst 3-month period, the same deal. One note, and I often communicate this to clients, I think it's an important lesson, is we had 3 of the worst 15 days in stock market history, but we also had 5 of the best 15 days in stock market history in March and April last year. So think about that. 3 of the worst, which you can see on the screen, but we also had 5 of the best. And we all know that's a natural reality of these volatility periods, right? You get these best and worst days sitting right on top of each other. And that's just an important reminder for clients that you don't want to move out after some of these worst days in stock market history because the returns are so abundant on the other side. And some of those best days in stock market history are on the other side. It was amazing how many folks we had, even some of the best investors we work with across the country, right? That temptation last March was enormous to get out of the market, right? Try to time the markets. That's the worst thing you can do. From a portfolio standpoint. I just think it's great to always have this on hand to remind clients of that reality, because you never know when some of these worst days are going to spring up on us. One of the stories that we talk a lot about, just looking forward on stocks right now, is all the cash on the sidelines, right? You think about, we just haven't spent money like we have in the past, right? Because of the pandemic, because of the shutdown, a lot of cash on the sidelines. And this is money market assets going back to the early 90s. And you can see where assets in these cash on the sideline accounts really peak pretty distinctly during periods of market turmoil, economic uncertainty, economic turmoil. You can see that there's very distinct peaks in these cash on the sidelines accounts. You can see it happened in January of 2003. That was following 3 years in a row in which stocks lost money. Right, in 2000, 2001, and 2002, you had the tech bubble and 9/11. Then you had January of 2009, right, the global financial crisis. That was the bottom of the global financial crisis. You hit 3.8 trillion in dollars on the sidelines in these money market accounts. And you can see the peak last year was 4.8 trillion back in May of last year. It hasn't moved much off that. We're still at 4.5 trillion through the end of June here. So there's a ton of cash on the sidelines. And this tends to be really supportive of risky assets in the near term, right? These dollars just eventually find their way back into the market. They can be supportive of prices in the near term. You can see here's 3-year returns following the previous peaks. So 3-year return for US stocks following the other 2 previous peaks. Following 2003, you average 16% per year the next 3 years in stocks. Even better following 2009. You average 19% per year the next 3 years. So very positive, I think, backdrop for stocks here. The one caveat I will say is that all this cash on the sidelines, certainly undeniable, but stocks are obviously much more expensive than they were in 2003 and 2009, right? We just looked at the returns of how much we've rallied off the March lows. That's a distinction from 2003 and 2009, right? You think about how cheap stocks were following 3 years in a row in which you lost money in 2003, or the bottom of the global financial crisis in 2009. It's a little bit of a different picture from that standpoint, but we still think in the near term, this is going to help stocks grind higher, right? I think we've already seen that really play out for the first half of this year. Switching gears a little bit and talking about fixed income, this story, we touched on a little bit earlier. We knew something had to give on the bond side. This is one of my favorite charts, and you can see I have a lot of favorites, but this looks at interest rates and bond returns by decade, going again back to the 1920s. And you can see the nice relationship here, the story that this tells. If you just look at where interest rates start out a specific decade, that's generally where bond returns finish, right? Wherever interest rates start, that's where bond returns finish. And you can see that it works out almost perfectly for each decade, right? Maybe plus or minus a little bit. And the challenge, of course, in today's world is that interest rates are so historically low that 10 years from now, we're going to look back and bond returns are going to be around 1.5%, right? They're going to be right around that 1.5% range. The lowest bond returns we've seen since that 1940s, 1950s period, when we had 20-year stretch in which bond returns were sub 2%. That's really the environment we're stepping into today. Probably one of the biggest challenges we hear from folks in portfolios, right? What do you do on the bond side to really deal with this low interest rate, low bond return reality? I think there's a lot of things you can do, right? I don't think there's one silver bullet answer, right? Some of the reality is embracing some flexibility on the fixed income side. Active managers outperform when interest rates go up. That's certainly one way, but it's also going to be other asset classes, right, as well, that can add some return, add some diversification to your overall portfolio. But I think it's good to at least make sure folks understand this reality, right? Just a different world than we've lived in the last 30 to 40 and really 50 years here of investing. This low interest rate reality is really a challenge. And it's the ultimate financial irony if you think about it, right? We've got all these baby boomers retiring, looking for safety, looking for income. And the interest rate picture looks like this, right? For that bond fixed income asset class. More challenging than we've seen in 70 years. Now, thinking about diversification, this is another one of our favorites that looks at a diversified portfolio, roughly 60% stocks, 40% bonds, various other asset classes, and just comparing it to the U.S. stock market or the S&P 500. And it shows just how emotionally challenging a diversified portfolio can be. I always joke with folks that you have a really well diversified portfolio if it never feels good, right? It never feels good. You probably have a pretty good mix of asset classes. And you see that, especially over this last 20-year stretch that we've had in investing. It's pretty crazy that you look at periods like 2008, you lost almost a quarter your assets in a diversified portfolio just in the calendar year 2008, probably one of the worst years ever for a diversified portfolio. Then you follow that up with a stretch like 2009 to 2019, 11-year period where it was the longest U.S. economic expansion in history. It wasn't the best, but it was the longest U.S. economic expansion in history. And look at how much the diversified portfolio trailed that U.S. stock market, right? You left 150% of the upside of U.S. stocks by being diversified and spreading your assets across a variety of categories. And you can see that certainly doesn't feel good either, right? Certainly we had a ton of folks who are wondering, right, is this the right portfolio? Does it still make sense, right? Am I leaving too much money on the table? It's a natural feeling in that environment. And of course, last year was the same dynamic played out in a much, much smaller time period, right? Where the first quarter, you lost money, 20% in the diversified portfolio. Then the last 3 quarters of the year, you trailed by a pretty healthy amount, almost 28%. So you get this dynamic going where you lose money, you trail, you lose money, you trail. It's really hard to connect the dots on why the diversified portfolio makes sense. So again, even for some of our best investors, we like to give them this reminder. And of course, the punchline here, is that the diversified portfolio, if you add up this 20-year stretch, it's a little bit more than 20 years. But if you add up this 20+ year stretch, the diversified portfolio actually ends up ahead. Not to mention it did so with a heck of a lot less risk. So for us, just a great reminder, right? Why we asset allocate, why we diversify, why we spread your folks' investment eggs across a variety of investment baskets, right? This is why we build portfolios the way we do, all right? To get to this type of outcome, what we call at Blackrock, winning more by losing less, right? Winning more by losing less. You don't need all the upside of what the bull market brings if you do a better job in those difficult stretches. It's just emotionally challenging and difficult for clients to connect the dots and see it, right? You get caught up in whatever period we're living through at that point in time, especially in the bull markets, right? That can last 11 years. You feel like you're leaving too much money on the table. But for us, just a good reminder for folks why we build portfolios the way we do. And you think about this 20-year stretch too, by the way, and we could probably do a 30-slide filibuster on this 20-year period, right? Think of everything that's happened here, right? Tech bubble bursting, 9/11, 2008 in the global financial crisis, the longest U.S. economic expansion sandwiched in. Then you throw a global pandemic on top of it here at the end. Pretty historic period. And look at how well the diversified portfolios held up. I think that really speaks to what we try to do when we asset allocate and diversify and build portfolios. Of course, I'd remiss if I left you without touching inflation, right? Grabbing headlines again, which certainly is something new, right? Something we haven't had to deal with probably in 20, 30 years. Is the spike in inflation. And certainly some of it's going to be transitory, right? That's a Federal Reserve word. I always hate that jargon word, right? Transitory sounds so fancy, but just means temporary. And there's certainly some items within the inflation index that will be transitory, right? That's purely because the pandemic played havoc with prices. Some of those things, though, there are other items in there that are going to continue to see price pressure. So we think it's a little bit of a mixed bag where some items will be transitory, but you're still going to see pressure on higher prices here really in the near term. And you can see the story here, inflation at 5.4%, but savings and interest rates are only about 1.4%. So that creates an enormous challenge, right? Just that disconnect between interest rates and where inflation's at today. It's the largest gap we've seen since the 1980s between interest rates and inflation. Right, where you're underwater in using just that 10-year U.S. Treasury bond, you're underwater by 4%, adjusting for inflation. And I just think we need to ring the bell on this more as an industry. We talked about all that cash on the sidelines, right? Just think about folks that don't have a good financial plan, that aren't investing or aren't putting some of that money to work. They're digging themselves a purchasing power hole, right? It's not something you can see necessarily, especially day to day, but we can see it in these periods where inflation is really ramped up. And I just think we need to ring the bell more, right? It's the biggest gap we've seen here in 40+ years. And I think a lot of investors, right, they see inflation, they can feel it a little bit, right? Certainly seeing it in housing prices, for example, today. But I think to really remind them that, hey, if you're not putting your money to work, if you don't have a good, sound financial plan, you're going to do some damage to your purchasing power. And certainly we think this is going to continue to be a challenge here in the near term. And one of the big things, I mentioned housing prices. This is really kind of a crazy dynamic, but something that I think a lot of folks aren't aware of, that actually housing prices aren't in the inflation index. It's actually something they changed in 1983 that's had an enormous impact on the inflation calculation. In 1983, they made that change because they were worried that housing prices were going up, but the cost of buying a house was going down because interest rates were going down. So it was cheaper to buy a home even as housing prices went up. So they changed from housing prices to actually using rents. What would you rent your house for in the inflation calculation? And that's had an enormous impact on inflation. It's taken a lot of the housing price volatility out of the inflation calculation. You see that on the left side of the chart. We just contrasted housing prices to rents. And you can see that we've got an enormous gap here between housing prices, right? We updated the number through the end of May, 16.5% housing price increases. It's the largest housing price increase in history, yet rents are only at 2.5%. So enormous gap between the two. If we actually had housing prices back in the inflation index, you'd be talking about 7, 8, 9% inflation. It would be that extreme because that housing component within the inflation index is actually the largest component within the index. 40% of the inflation index is shelter. 24% of it is this rental number today. So it's an enormous driver of where inflation sits. And if you stare at the chart on the left side long enough, not that I recommend doing that, I spend too much time doing that day to day, but you can see rents actually trail housing price increases. So whenever housing prices go up, rents tend to lag that, and you're going to start seeing rents tick up. And they actually did that in this last inflation report. They jumped from about 2 to 2.5% because rents start to catch up with housing prices. They don't go up as much, but you're going to see a lot of rent pressure here within that inflation index, which is part of that component of inflation that we're going to see ticking up here. That'll offset some of those things that are transitory within the inflation basket of goods. So I think I'm out of charts there, believe it or not. Hopefully that was helpful, right? Think about where we started. We've had a good run the last couple of years, but we knew something had to give, and certainly that was going to be on the bond side, right? The backdrop for stocks is probably a little bit more positive. We've had a huge run though off the bottoms, right? But there's a lot of cash on the sidelines, and history tells us that creates a pretty positive backdrop in the near term. The bigger challenge is going to be on the bond side, right? Just the fact that interest rates are low. Low interest rates mean low future bond returns, right? How do you deal with that in your portfolio? A lot of ways to get it done. There's no silver bullet, but a lot of different things that we can do to help boost returns, but also maintain a level of diversification there. And I think it's always important to remind folks, right, about diversification and connect those dots for them. Don't assume they get it, right? It's just emotionally challenging as we go through some of these periods to see how well the diversified portfolio is held up, especially over that 20-year window that we looked at. And inflation, I think we just need to ring the bell on it, right? It's not going to go away. The gap between inflation and interest rates and savings rates is the largest we've seen in 40 years. I think we just need to make sure folks, right, are invested, putting their money to work. Otherwise, they're losing purchasing power. And we shouldn't underestimate that, right? It doesn't take long to dig yourself a purchasing power hole there if you're not attentive to that reality. So I'll stop there, see if there's any other thoughts or questions or comments out there where we can fill in the gap.
Questions now, but we'll give a minute or two if anybody wants to post there. Feel free to email any questions you have after this presentation too. But Mark, thank you so much for your insight in joining us today and your time. And Sharad, thank you as well. And just also want to thank Ken and Shane for coordinating all these speakers for us today. This was an amazing presentation on the investment side of employee benefit plans. We really appreciate you all being here. This presentation has been recorded, so I will share this with everyone attending today, as well as anybody that might have missed it, and feel free to share that out too. So thanks again. Let me just check here. I don't see any questions yet. So thank you so much for joining us, and I hope you guys all have a good rest of your day.